Good morning, everybody. Hope you're having a good day today. Today we're going to move into chapter 3, which, as you can see from the PowerPoint I've got up, talks about more about the auditor's ethical responsibilities. And also we're going to talk about the legal responsibilities of auditors, what happens when things go wrong. Unfortunately, in the auditing world, things don't always go correct because, as we've already talked, auditors do take some risk in performing their auditing work. Because auditors do not look at every transaction 100% that occurs in a corporation throughout a year, that means that they do take some risk with respect to the fact that some of those transactions that they don't look at could in fact be incorrect and perhaps materially correct. Although, based on the amount of work that an auditor does and the timing of their work, auditors believe that most of the time their financial statements are materially correct, and most of the time they are. That doesn't mean that on occasion something may go wrong. So we'll delve into that a little bit more today. So in chapter 3, again, I bypass through the first few PowerPoints here with respect to the learning objectives. These auditors' responsibility to society, if we think about this in a broad context, we have moral responsibilities, and this speaks to who auditors are expected to be in our society. And the most common phrase we see here in the PowerPoint, a public accountant should be upright, not kept upright. So based on their own decisions, auditors should be making the proper decisions. They should have integrity, some of the things that we've mentioned earlier on. Auditors have professional responsibilities, and we have rules of conduct that we've touched on briefly. We'll talk a little bit more about those today. And then auditors also have legal responsibilities, and those legal responsibilities are in two areas of law. Civil law. Civil law means that auditors can be sued if they cause damage to other parties. And then, of course, if auditors commit a crime, they can also perhaps go to jail, as well as encounter other financial penalties. Some of the first few PowerPoints here, again, on general ethics, you're not really responsible for. We know that auditors are supposed to act in an ethical way. And the first number of these PowerPoints just talk about ethics in general and how you can make decisions when you have ethical issues. Okay, so we're not going to, you're not responsible for that. The first one I really want to concentrate on a little bit is professional skepticism. And so this is PowerPoint 12. What is professional skepticism? It's an inclination to question all material assertions made by management. Okay, so let's look at these words for a few minutes. An inclination. It does not mean that auditors assume everything that management says is incorrect, or that for some reason management is not telling the truth. However, auditors, because they are hired by board of directors on behalf of shareholders in order to, in essence, check up on management, auditors have to have what's called professional skepticism, which means that they are inclined to question what management does tell them. And so essentially auditors just take the approach of show me evidence to support what you're saying. We're not saying what management says is incorrect or invalid or always wrong. We're just saying, show me some evidence to prove that you are correct and to support your assertions. Now, auditors don't have to question all assertions, of course, because some assertions or statements made by management are not significant or what we call material, right? They're not going to affect the decision of a user of the financial statements. However, where management does make material assertions, again, material assertions being assertions that could affect the decision of a user of the financial statements, auditors are expected to do so with professional skepticism. We have to realize when management makes assertions, some of those may be written, some of those may be spoken or oral, or of course, management's assertions are reflected in financial statements themselves in the actual accounting records. Okay. The first major area in this chapter is really PowerPoint 16. And what it's talking about is codes of ethics. And again, we mentioned earlier, codes of ethics in Canada, these are governed by provinces and territories. That's why this is referring to provincial bodies in Canada. And then the IFAC, that's the International Federation of Accountants, that is the International Code of Conduct, but they're all basically very similar to each other. Okay, so for our purposes, the Code of Conduct, which we have to deal with in Ontario, in our country, is virtually the same as the International Code of Conduct. And that's why, again, we can look at some of these ethical requirements, and they're the same internationally as what we have in Canada. So in Ontario, because again, provinces cover the labor laws in our country, and so in Ontario, all CPAs have a handbook, and it's called the Members Handbook, and it talks about many, many rules of professional conduct. Actually, if we went into the handbook, there's in the range of around 300 different rules, and so of course many of them are very detailed, but there are sort of broad themes that we can talk about with respect to the Code of Conduct, and that's what this PowerPoint is addressing. So let's look at these 5 areas, and we'll comment a little bit more about each of these. The first one, professional behavior. We are required, a CPA is required to serve the public interest and maintain the good reputation of the profession. So when we say we are required to serve the public interest, that means CPAs are not required to serve their own interests first. They have to put the public interest first ahead of their own interests. So that means you have to have a higher standard in terms of the work that you do, because the needs of others have to come before your own needs. And of course, because of human behavior, sometimes CPAs may fall short of that requirement, but by and large, they are successful in meeting the public interest. That, of course, is why there is an audit profession, because auditors serve the public ahead of themselves. And then also maintain the good reputation of the profession. So that means, of course, refers mostly to ethical conduct of auditors. We shouldn't be doing things that might cause us to go to jail. We shouldn't be stealing money or other assets from other people, right? We should be conducting ourselves when we're in the public in a proper way. So that means things like, we shouldn't be drinking too much or using drugs and things like that. That are things that many members of society would not think that CPA should be doing. So it means we have to have a high standard in terms of how we behave, even in our own personal lives, because again, people can observe us, right, and see the things that we're doing or the things that we're not doing. So we're called to have a very high level, high personal standard of behavior. The second point, integrity and due care. It says we have to perform our services with integrity and use due care. So integrity with honesty, right, forthrightness, and use due care, which means we have to be careful. And when we do our work, we should not be negligent. Due care is actually a legal concept. And when auditors do not use due care, or when they're not careful in their work, or when they are negligent, this can cause legal problems. And we'll talk a little bit more about that in today's lecture a bit later. Professional competence. Of course, one way to ensure that the public does see the services of auditors as being something that they want is auditors have to be professionally competent, which means we have to have the skills and training included in maintaining our competence over time, right, throughout our entire careers. And in order to accomplish that, That means you have to have professional education and experience. So many years ago, actually, when I first obtained my own CPA designation, um, you had to pass a set of exams and, of course, go to school. But once you passed your exams, basically, there were not any other requirements to maintain your competence. Well, after I was in the profession for about 10 years or so, the profession changed its view on this and said, society is changing so quickly, business is changing so quickly, we have to have CPAs who are going to maintain their competence throughout their entire career. And so the profession introduced the concept of continuing professional development. And so this is a case where throughout your entire career, you're expected, of course, to maintain your knowledge of the accounting rules, the audit rules and standards, income tax rules, etc. And of course, normally you can do that by either teaching courses, such as I do, right? That's why I enjoy teaching so much myself, is it's an easy way to maintain my own competence. Or of course, you can take courses, right? Our professional body in Ontario, CP Ontario, offers courses, and it's the same thing internationally, right? There's a requirement to maintain your professional competence. So taking courses throughout your career is another way to do that. Confidentiality, extremely important. CPAs gain a lot of knowledge, right, about what's going on in their clients' business affairs. And the concept of confidentiality says that we should not disclose or exploit confidential information that we acquire in the due course of our professional work. So if we obtain information about a company, for example, we should not use that information to do insider trading, right, on a company's shares, because that information is confidential. We may find out a lot of things, right, not only about the company, but about management and a lot of these trade secrets, right, or other personal information we may gain access to, people generally would not want disclosed. And so we're required to hold that information in confidence, right, and not disclose it to others. Confidentiality, CPAs do not have the same legal protection that lawyers have, right? Lawyers are not allowed to disclose ever what their clients tell them. A CPA, while we have a duty not to disclose information, if we were in court and a court ordered us to disclose information, we are required to do so. Okay, and so it's a little different than a lawyer. A court cannot actually require a lawyer to disclose information passed to them by their client, but for a CPA, a court can do that. But putting the court situation aside, CPAs have to keep information in confidence, which just means keep it to yourself, right? Don't tell others unless generally ordered by a court to do so. And then number 5, objectivity. Objectivity really means that we control our own destiny, right? In order to be objective in our work, our judgments cannot be impaired or perceived to be impaired. And by impaired, of course, very commonly, if we're too close to management, right? Management might influence how we think and how we do our work. And so we have a special term referred to as independence, right? Auditors must maintain their independence from management. It means that in your state of mind, right, you have to make decisions the way that you think the decisions should be made, not the way that management thinks or anyone else thinks. I mean, the concept of independence is one of the most important standards that we have to meet as CPAs. The next PowerPoint, number 18, talks more about the international rules of conduct. And again, you see the same words here: integrity, objectivity, professional competence, due care, confidentiality, professional behavior. So again, the whole idea is we want to conform, right? Achieve conformity by causing CPAs to live up to a very high standard in the professional work. So that's basically the same throughout the world. Okay. just going to go forward a little bit. A few of these slides talk about each of these concepts that I've already mentioned. So again, you can look at it, read them through yourself in a little more detail, but I've already given you the most important information that you need. Okay, so in terms of this word independence, right? Independence, we've mentioned before, auditors are required to be independent in fact and independent in appearance. Independence in appearance means as people observe you and what you're doing, it's what people can see. Would people, other business associates, say that you are independent or not? Independent in fact means what happens behind closed doors when people can't see you, right? Are you acting in an independent way or not? So let me give you a little example of how the rules around independence might be applied. So let's say that we're conducting the planning for an audit that's going to happen this year for a particular client. And the audit team, okay, is at the auditor's office, and I invite the client's CFO to come in, okay, to the meeting. And during the meeting, the CFO for our audit client says that, you know, we have some customers that aren't paying us on time, so we're a bit concerned about having to increase the allowance for doubtful accounts before the year end and record a significant bad debt expense. And so as the audit partner, I might say in front of everybody in the room, that's fine. Thanks for bringing that to our attention. We'll give that allowance for doubtful accounts some special attention during the course of our audit to make sure that that number is properly recorded. And then after the meeting is done, I go to lunch, right? The audit partner goes to lunch with the CFO. And the audit partner says to the CFO, "Oh, don't worry about the allowance for doubtful accounts. You know, I'll make sure that it doesn't impact your earnings too much this year." So what's happening there? When everybody was together, right, I was acting in a way where when I appeared independent, right, I was independent in appearance because everybody in the meeting thought, "Oh, the audit partner is doing what I would expect," telling the client, "Yeah, we're going to do extra work in that area, right, to make sure it's properly recorded." But when I went to lunch, right, when the audit partner went to lunch with the CFO, I changed my position and said, "Oh, don't worry, right? Don't worry about that allowance. I'm on your side, really," right? Is what the CPA was saying. And in that case, of course, you're not independent in fact, right? When behind closed doors, when the other people in the audit firm can't see you, you're agreeing with the client, right? So that does not meet the rules of professional conduct if you do that, okay? So auditors have to be independent in fact and independent in appearance. This whole idea of auditors being independent, in fact, is in our law, okay, in North America. Then you see reference here to the Canada Business Corporations Act. And we also have a similar act in Ontario called the Ontario Business Corporations Act. And they're both, they both require the auditor must be independent of management. So we see here qualification of auditor. A person is disqualified from being an auditor of a company if he is not independent of the corporation. And so independence, right, is enforced not only in terms of our professional rules of conduct, but also in the corporate law, right? In Canada and in many other countries, independence is one of the most important standards that auditors must meet. Excuse me. Now, the next PowerPoint, number 25, talks more about the idea of independence and talks to some of the concepts I've just mentioned, right? Independence is a question of fact, right? We have to look at all the facts, and given the facts of the situation, we see that the auditor is independent in fact and independent in appearance or not, right? We have to look at all the information. Item B here, in terms of the act, it says a person is deemed not to be independent if the auditor or their business partner beneficially owns or controls, either directly or indirectly, a material interest in the securities of the company or any of its affiliates. So what they're saying is auditors cannot own a material interest in their audit clients. In fact, most firms insist that their audit partners and staff own no shares, right, in your audit client, because it might threaten your independence. And if something were to go wrong in the conduct of an audit, this would be an area in which lawyers would intervene and really question, were the auditors independent or not, and they would try to build a case for their client that perhaps the auditors did not meet this legal requirement to be independent, and that caused damage, right, to their client, for which their client should be compensated. So this is a very important area, and unfortunately an area where you can get into some difficulty, right, as auditors, because one of the challenges here is that professional firms encourage their partners to be close, right, to their clients, because if you're close to your clients, that means that your clients will sell. You'll be able to sell more services, right, to your client, because you'll know more about what's going on in their business. You'll know about more about the opportunities that you can use to improve your client's business operations and help them be more profitable and more efficient. And that's what the firms want you to do, right? Sell more services so that the profit of the firm can be higher. Of course, you can be too close to your client, right? And when you're too close to your client, this can damage your independence and whether you're acting, in fact, in an independent way or not, right? And so let me give you an example of something that happened fairly early on in my career, where maybe my independence might be subject to challenge. And so what happened was, about 6 hours north of the Windsor area over in Michigan in the United States, there's this ski resort there, winter skiing, snow skiing. And so I took my family there for a 3-day weekend, and so we could enjoy some time together. And when I came to check out at the end of the 3 days at the resort where we were staying, they told me at the reception, they said, "Oh, well, the bill's already been taken care of." I said, "Oh, really?" I said, "Well, I was very surprised." And so I inquired. I said, "Well, who took care of the bill?" And they mentioned a company name. And I recognized the name of the company. Of course, that was one of the audit clients that I was handling at the firm. So this is when I, earlier in my career, was a partner with Deloitte. And so as a partner with Deloitte, I came back to the office, and then as I was thinking about the situation, right, this particular client was one of my larger clients that I was handling, and I was thinking, is my independence damaged because the client paid for this trip for myself and my family? Now, I could afford the trip, right? Obviously, I went on the trip thinking I would have to pay for it. So I asked my partner in the office, who was the managing partner at the time, I said, "Well, do you think that I have a problem with independence because the client paid for my trip?" Because I said, obviously I can reimburse the client for the trip. So the partner thought about it, and he thought, no, he said, I don't think that there's a problem with independence in this issue. And the main reason he felt that way was that, I could have paid for the trip. I could afford the trip. It's not that the client was, paying for it because I couldn't. And so, was I obligated to do anything for the client because they paid for the trip? Well, so maybe in fact, right, going forward, I was still independent of the client, but was I independent in appearance, right? Someone else outside the firm, if they knew that the client had paid for my ski trip for my family and myself, what would someone else think, right? It's not so much what I would think, it's what would someone else think. And if someone else would think maybe their independence has been impaired, it could be a problem area, right? So a lot of these areas with respect to independence, they're judgment areas, right? It's not that something is right or something is wrong. It's often a situation where you're going to be in what I call the gray zone. It may be right, it may be wrong, and you have to be able to use the professional judgment to decide, is it right or wrong? And again, where you're uncertain, you consult with others, right? Talk with other partners in the firm. How do they see it? there were various things we could have done. I could have reimbursed the client for the trip. I didn't, because my managing partner didn't think it was necessary. Had there been a problem, we could have shifted that client from myself to another partner, right? That would have also been possible as well. Okay. Now, sometimes, of course, if you're not independent, there's a duty to resign, right? Because the law says, and our professional standards say, you must be independent in doing your professional work. So on an auditor who becomes disqualified, right? Disqualified because you're not independent, you have to resign, right, from the audit, because we don't want the public thinking that you are independent when in fact you're really not, right? This can cause a great problem, right, in terms of public reliance. So both the International Federation of Accountants and, of course, in Canada, our CPA Institute, they've identified 5 threats to independence. Okay, so typically on midterm exams, I may ask a question around, list 3 or 4 threats to an auditor's independence and briefly explain what they are. So let's just walk through these together. Okay, so self-review. Right? Self-review means that an auditor would be providing assurance on their own work. Well, how might that happen? Well, sometimes clients, their controller, right, in their company may go off on a maternity leave, or they may be sick and be off for a while, and the client might say, audit firm, can you supply one of your staff members, right, to come in and be the controller for my company for a few months, few weeks, whatever it might be? And the audit firm will very often say, yes, so and so, right, can go in. One of our staff members will go in and be your controller. But when that person's there as the controller, right, they're doing what? They're controlling, of course, financial information, aren't they? They're making decisions. Well, then if the auditor goes in after the fact, right, and wants to audit the transactions during the year, and part of those transactions were conducted by their own staff member, this might create a situation where there's a problem with self-review. Right? Because the audit firm is, in essence, auditing their own work because of one of their staff members did the audit. So you would have to take steps to either remove the threat or reduce the threat to an acceptable level. So what might happen here in this case, if the audit firm wants to help their client, they might say, yes, we can send in one of our staff members to help, but it won't be the staff member working on the audit, right? It'll be one of the other staff members from the firm. And so the people actually working on the audit are not the same people who actually did the work, right? So we can take steps to either eliminate the threat to independence or reduce it to an acceptable level. By having a staff member other than someone who's on the audit team, we can reduce that self-review threat to an acceptable level. Self-interest. Self-interest threat would be, as explained here, a benefit from having a financial interest in the client. So if you're a partner or if you're even a staff member, right, and you have a material financial interest in the client, meaning that you own shares, right, typically in that company, would you want the financial statements for your client to be positive or negative? You would want the financial statements to be positive, right? So in the conduct of an audit, you, because you have a self-interest, you might overlook information that's negative, right? And not bring that to the attention of your audit team or your audit partner. And some negative things might not get dealt with during the course of the audit as a result of your own self-interest. Of course, this is why all professional firms, typically they require each staff member, each partner, to sign a form each year saying that you are independent of all the firm's audit clients. And they will ask you specifically, do you own any shares in any of the clients that we audit? And that's directly or indirectly. And of course, very often, if you own mutual funds and things like this, you'll have to review, right, what companies your mutual funds own shares in, and if they own material interest in some of your audit clients, you're going to have to dispose of your investment in your mutual fund. So again, the idea of an annual sign-off, right, by audit partners and audit staff is meant to address the self-interest, right, and just make sure that that type of a threat to a firm's independence does not exist. If it does exist, as I said, normally you have to dispose of your shares. The third threat is what's called advocacy. So advocacy is an old term. It comes from a French word, originally avocat, and avocat refers to, in French, it's the lawyer, right, acting for a firm for their client. Been generally expanded to the word advocate, right? So if you're an advocate for your client, that means that you're promoting a client's position or the client's opinion on a certain matter. So auditors should not be advocates for their clients. So here's an example of how that might occur. Your audit client might want to raise additional capital, right? And so they want to go to the bank to borrow money. Well, very often, right, when I was conducting audits as a partner, my audit client would say, hey, can you come to the bank with me, right? I want to borrow more money and I want you to be there, right, to help me do that. Well, as the auditor, I would say, well, I can go to the bank with you, right? But it's only on the basis that I'm there to answer questions about the financial statements, right, that the banker might have. I cannot tell the bank that they should make the loan to you, right? If I told the bank that they should loan money to my client, I'm being an advocate for the client, right? I can't do that. I can answer questions, right, that the banker might have, but I cannot tell the bank, yes, I think you should give the loan to my client, because that would be advocating, right, for my client. So advocacy, one way around that, of course, don't go to the meeting with the bank, then there's no issue. But in order to reduce that risk to an acceptable level, what you do is, right, you do not make a recommendation one way or the other to the bank with respect to whether they should give your client the money or not. You simply provide information to the bank, right, at their request. Number 4 is familiarity, right? If you're too sympathetic to a client's interests. And so that's an example really that I just gave you, right, with respect to my skiing trip, right? As a result of that skiing trip, would someone say that I was too close, right, to the client? Possibly. What if I told you, with respect to that same client, right, I would have lunch with them twice a week, right, with members of management? It just didn't happen, but you know, if I went to marriages, right, of their children, or if I went to anniversary parties, right, for the husband and wife, right, if you were part of their social circle, if I went out, right, to dinner with them on weekends, right, or I partied with them on the weekend. If you were close to your client in that manner, you're building up a relationship, right, a personal relationship with your client. It could be that you're too familiar, right, and so this is always something that you have to be careful of as a CPA. Is you want to be friendly, but you cannot be friends. Okay, so there's a difference. You can be friendly, but you cannot be friends. And so very often, even with respect to courses, right, that I conduct at the university, I often get requests from students. They want to be friends on Facebook, right? So normally, I've made the odd exception, but normally what I do is I tell students, I cannot be a friend with you on Facebook until after the course is over, right? Because during the course, while it's going on, we can be friendly, right? I can treat you with respect. You can treat me with respect. We can have a professional level relationship, a student and instructor, but we can't really be friends, right? We can't be friends where we might be doing favors for each other, right? Or going to an extreme to help each other. Why? Because we're too familiar, right? And so in our professional work, this can become a problem. But even in terms of a student-client, right? Sorry, student-instructor relationship, it can be too close. So if we're too close, right, am I giving you grades that you don't deserve, right, because of our relationship and knowledge of each other? So I wouldn't want that type of threat, right, to influence our relationship. And so as a consequence of that, right, I want to reduce the threat to an acceptable level or eliminate it. So what I do is I tell students, uh, I tell students that I can't be a friend with you on Facebook during the course, but after the course is done, yes, you can, send me a friend request and I'll say okay. Right. So that's the idea, that we can become friends, right, long term, and stay in contact even after you graduate, but we cannot be friends while the course is going on. Why? Because of this familiarity issue, right? There could be challenges around grades. There could be challenges around a lot of different things, right? So we can't have too close of a relationship during the course. We can be friendly to each other, of course, right, and treat each other professionally in a nice manner during the course going on, right? You need help, I can help you, right? Just send me an email. Uh, but other than that, we can't get too close, right, during the course. Afterwards, yes, then we can exchange emails, right, and stay in touch. Okay. And you can see that's a gray area, right? It's not right or wrong. It's a matter of how close is too close, really. So it's a judgment call, isn't it? The last one is intimidation. So this can, of course, create an issue between clients and auditors. If an auditor says to their, the client says to their auditor, you either do this particular action or you're not going to be our auditor next year, right? They threaten to fire you. Well, you cannot be put in a position, right, where your client intimidates you, okay? So a common area of problem here might be if you have a major client, right? Let's say you have one client, which is 30% of the fees that you generate as a firm. Intimidation could be a problem, right? Because if that one client says, I don't want my audit report to be negative, and I want you to overlook these particular things that happen during the year, you might have put yourself in a position where your client can intimidate you, right? Because that one client is 30% of the fees, right? So there may be somewhat of an indirect self-interest, right? Because the client is too large, and or you put yourself in a position where you can be intimidated by the client because they are such a large part of your practice. So this comes down to even practice management, right, amongst firms. Not so much for the big international firms because they have lots of clients anyhow, but typically for smaller firms or mid-sized firms, right, you have to be careful that one client is not too much of your practice, right? Because it can, again, go to situations where you're over reliant, right, on that client for fees during the year. And again, that can put you in a bad position where your client can, not that they would, but they can indirectly intimidate you, right, by the fact that you have a fear, right, inside yourself that, gee, if that client left, I might run into financial difficulty, so I don't want that client to leave. Well, that's really indirect intimidation, isn't it? The client's not actually saying anything to you, but they're intimidating your behavior because they are such a significant client. Closely related to self-interest there, but you can see the nature of the problems here, right, that we're talking about. So we have all these threats, and again, the auditors are required to either eliminate the threat, okay, take a step to eliminate the threat, or reduce the threat to an acceptable level, right, which is, and essentially means to manage the risk somehow. Okay. Okay, so I'm just going to skip through a number of the particular PowerPoints here because they talk about detailed areas about what's allowed, what's not allowed with respect to a number of different situations. You're not required to know, okay, the PowerPoints that I'm skipping through right now. Okay, so we're going to go over to number 38, which talks about professional competence and due care. So we've already mentioned this a little bit with respect to the fact that auditors have to be competent and use due care, which means not be negligent in the course of their work. And of course, this particular PowerPoint is just before we're going to talk about legal consequences for auditors if they don't use due care. Okay, and of course, if you're not professionally competent, that means you might make mistakes, right? Well, of course, we don't want that to happen either. So this PowerPoint states professional competence and due care are required under the rules of conduct. Okay, makes sense. You have to know what you're doing, right? And you have to be careful when you do it. So these are requirements under GAS, Generally Accepted Auditing Standards. Just reading the PowerPoint, it says the professional competence and due care principles are a comprehensive statement of general standards that accountants are expected to observe in all areas of practice. These are principles that enforce the various series of professional standards, professional competence, of course, due professional care, planning and supervision, right? If we're going to be competent and use due care, jobs should be properly planned and people need to be properly supervised, right? We have to somehow oversee the people to make sure that they're doing the right things. And then we have to, of course, gather sufficient data, and that data needs to be relevant, right? Means we have to have the right type of data. So you might recall we talked earlier about auditors have to gather sufficient, appropriate audit evidence. That's what this last point is getting to. How can you acquire sufficient, appropriate audit evidence if you're not competent, right? If you're not competent, you don't know what sufficient, appropriate audit evidence is, right? So in order to be able to satisfy the rules of professional conduct, right, we have to maintain our competence so that we can properly plan an exercise or an audit, so we can properly supervise our people, right? If we're not competent, how can we supervise our staff, right? If we don't know what we're doing, how can we tell our staff what to do? Right? So a lot of these standards and the actual work we do are actually intertwined or interrelated with each other. Okay, so public accountants, auditors specifically, had to perform the professional services in accordance with generally accepted standards of audit practice, right? So that's why we have the standards, what we call generally accepted auditing standards. Due care, we've already mentioned, is one of them. The practical effect of this rule is to make non-compliance with all technical standards subject to disciplinary procedures. So this means that if you do something that's wrong, right, and you are not professionally competent, you don't properly plan, right, your work, you're not fulfilling your work in a competent way, you're not taking due care, that means you're subject to discipline. Right? Discipline means that your professional body can take steps to protect the public against you. Right? For example, the professional body might require you to take courses, right, if they think there's a competency issue. If you did something wrong, the professional body might fine you, right? They might suspend your practice for a while, which of course would hurt you financially, right? They may actually shut down your practice permanently, right? If you were doing things which were illegal, perhaps, okay? So if you don't follow the professional standards, it means that the profession itself is not going to put up with that, right? So we have a series of reviews that the profession itself does. So in Canada, and this is the same internationally, we have what's called peer reviews. Peer reviews is where a CPA of one office will go and review the work of another CPA, right? So in Ontario, CPA Ontario comes in and reviews practices, right? So myself, I still conduct a practice. And because I conduct a practice, actually I just had a practice inspection, which was fine. And every 3 years, right, CPA Ontario comes in and reviews your practice to see what's going on. And they'll say, yes, it's okay, or they might make recommendations with respect to how you have to improve your practice standards, okay? And of course, you have to report back whether you complied with the recommendations that were made or not. But the profession itself, right, tightly controls what you're doing as a professional. Why? To protect the public interest, right? It's all about protecting the public interest. Because if we don't protect the public interest, it may be damaged, right? And if it's damaged, then the public's not going to want to reply or to rely on us, right? If the public's not going to rely on us, that's going to be very negative, isn't it? So the profession itself, again, we have peer reviews where CPAs go from office to office to review each other's work. The large firms, so Deloitte, KPMG, all the large firms, PricewaterhouseCoopers, they will review each other's work, right? And so every few years, Deloitte will go in and review KPMG's work and vice versa, right? And they'll make recommendations on how to improve the professional practice. So there's a significant amount of CPAs sort of taking care of themselves, right, through these different practice reviews to maintain the competence and the quality of the work that's being done by the profession generally. Why? To protect the public interest, right? Because if we don't protect the public, right, we're not going to have an audit profession for too long. Okay. So what we'll do here, I'm just looking at the time. I've been talking for about 50 minutes or 55 minutes or so. So I'm just going to stop here before we get into the next section for today, talking about the legal environment in which auditors work in. Okay, so we'll break for about 10 minutes. And I'll come back and then we'll go through the next 20 PowerPoints or so to finish off for today. Okay, thanks everybody. We'll see you in about 10 minutes. good economy from the late 1980s up until around the year 2000. Around the year 2000, we had what was called a dot-com bust. A lot of technology companies went bankrupt. And in addition to that, there were some very severe bankruptcies in the corporate world. One of the companies you may have heard of, I may talk more about today, a company called Enron in the United States. It's sort of one of the leading cases of major what we call financial statement fraud. So financial statement fraud is where management intentionally misstates their financial statements in order to create a situation where investors will invest money to management's benefit, of course, and then they ultimately end up losing that money because the financial statements were materially incorrect. In addition to Enron, there were a number of other companies, approximately 10 to 15 other companies, fairly large companies that went bankrupt all around the same time, say from 2002 to 2003 time range. And so this is very unfortunate and created a situation, of course, where auditors were sued because financial statements were misleading. The consequence of all this was that the U.S. government got involved in the U.S. audit profession. In Canada, we were able to prevent our government from getting involved by taking action ourselves as an audit profession to more tightly control the work of auditors so that the type of situation that occurred in the United States would not occur in Canada. And of course, many of the changes that were implemented in the United States have been implemented around the world with respect to a higher degree of corporate governance now, something called the Sarbanes-Oxley Act in the United States, referred to as the SOX Act for short. Sarbanes-Oxley is actually the name of it. And it created essentially a new standard for auditors that they had to meet if they wanted to carry on the audit business. And I'll mention a few changes as we go forward here, talking about the legal environment. So when we talk about the legal environment, just looking at the PowerPoint for a minute, it says legal liability is an important measure of the cost of failing to fulfill professional responsibilities to society. So when we started today, we said, well, part of the responsibility that auditors have is to fulfill their professional responsibilities. Why? Because the public is relying, right, on the auditors to do this. And if the auditors aren't going to do it, then the public has to be protected. The second bullet point says public law includes criminal law, administrative law, and constitutional law. All public law is codified by statute passed by some level of government. So we have essentially criminal law is what I would call it, okay? And we have civil law. So criminal law is basically law where you can go to jail, right, and have significant fines. Civil law is where you can be sued for being negligent, but you don't go to jail, okay? You get a financial penalty of some type. So laws which are passed by governments are called statutes. So from time to time, you'll hear the word statutory law. That just means it's a law passed by a government, and because the government has passed the law, it's called a statute, hence the word statutory law. However, we have another system of law in North America, which is called the common law. And the common law is the law which develops over a period of time as a result of courts making decisions, right, on certain court cases. And so over many, many years, that law, right, is developed. And so it's not law passed by a government, but it's rules created by the court system. Okay, so we call this in North America the common law. And when courts make decisions, these decisions are binding, right, on future cases that might deal with similar problems. Now, when we talk about the problems that auditors have, why do auditors have difficulty? Right? Why are they sued? So you see in this PowerPoint, number 41, they took a sample just of 129 cases, and here's the breakdown of the legal issues that arose in the cases. First one was misinterpretation of accounting principles, 33%. So that means that roughly a third of the cases, right, where auditors are being sued, it's not because of their audit work being a problem, it's how they interpreted accounting standards, right? So the International Financial Reporting Standards, if the auditors misinterpreted how those accounting standards should be applied, that could result in um, a lawsuit. The second item they mentioned, misinterpreting auditing standards. Okay, so uh, not understanding what the auditing standards are meant to achieve, 15%. Right? So we see the audit standard in front of us, we can read it, but we're misinterpreting what it's saying. So that's 15% of the cases resulted in legal claims. The next item, 29%. So again, almost a third resulted from the faulty implementation of auditing procedures, right? So that's we understood what the standard was, but when we tried to carry out the standard by performing an audit procedure, we did it improperly, right? So that's almost a third of the cases. But you add these two together, right? The 15% and the 29%. So getting close to half, right? Half of the lawsuits are because auditors misinterpret auditing standards, which means, again, they don't understand what the audit standard is trying to achieve, or, and more importantly, they don't apply it properly, right? So faulty auditing procedures. A relatively small number of the legal claims are actually based on client fraud, only 13% out of the 129 cases. But the problem with client fraud, even though it might be only a small percentage, where it does occur, it's usually very material, right? It's very large in dollar amount. And so this creates a situation, of course, where many people can be hurt, maybe lose their life savings, right, in many cases. So that's a problem. And then I always find the last one's kind of interesting. Fraud not by the client, but fraud by the auditor. So the auditor itself, right, might be committing a fraud. So this might be a case where, for example, maybe the client, right, and the auditor were too close in the relationship, and the auditor tried to cover things up for the client. Right? So the auditor knew something was wrong, but they signed an audit report anyhow. So 7% of the cases. So 7%. I mean, it's getting towards 10% of the lawsuits are because the auditors might not be following, right, rules with respect to independence. When you read the rules of professional conduct, the international rules are the same, are rules in Ontario. There's multiple pages in the handbook that we referred to earlier today, multiple pages that deal with this independence issue. So it's a serious problem, right, as far as the profession goes in trying to control, right, the relationship between auditors and their clients, to the point where auditors are part of the problem, right? 7%. So again, rising to 10% of the cases where the auditor's committing the fraud, not the client. Okay. The next PowerPoint talks about auditor responsibilities. It says users of audit reports expect auditors will detect fraud, theft, and illegal acts, and that will report on them, right? So when someone hires an auditor, what is their expectation? They would expect, right, the auditors to find fraud, at least if it's material, theft of assets, again, assuming materiality, illegal acts performed by the corporation or management. So to find these things and then to report on them, right? So, but when you look at these words, what's the expectation of the users? Right? It says detect fraud, theft, and illegal acts. It doesn't talk about materiality, does it? It doesn't mention how significant the fraud must be. It doesn't mention how significant the theft might be or the illegal acts. So are auditors supposed to find all of these things regardless of size? Probably, right? This is what the users expect. But what do the auditors reasonably expect to do? Well, the auditors think, well, I can't find theft, which is not material. I can't find fraud, which is not material. And illegal acts, which are, not significant, not material, I won't necessarily find either. So auditors take the view, we'll be responsible to detect material misstatements, right? Something that's so wrong that it might affect your decision. So in the audit world, we have something that we call an expectation gap. The expectation gap is the difference between what the users expect the auditors to do, find all fraud, theft, and illegal acts, and what the auditors are taking responsibility for, right? The diligence of the auditors are able to accept. So the difference between what clients want and what auditors can give them, there's a gap between the two. And the gap, even where the auditors have tried to do a good job, of course, that gap can result in lawsuits because the users of the financial statements have lost money. They have to blame somebody, right? And so, because of this gap problem between what auditors can give users of financial statements and what users expect, this is often the area in which lawyers get involved and try to create a situation where auditors have legal liability to others who have relied on their work. Okay, my screen seems to have frozen up here for some reason. Just trying to get my PowerPoint to work here. Okay, my PowerPoint has frozen up for some reason. So what I'm going to have to do is go out of the class for a few minutes, okay? And I'll come right back in. Okay, so just give me a couple minutes and I'll be right back. Auditors and what they can choose to deliver and what expectations their users have. So there's a gap. So sometimes this results in users saying, hey, auditors, you didn't do the work that's required of you, and so we're going to sue you. Okay. So we already mentioned the fact that we have something called common law and statute law. This PowerPoint just speaks to that. This common law is based on precedents. Precedents means cases decided earlier on in time and past decisions of the court. It says common law is not enacted by legislation. So this is not the government, right, making the decision. It's the court system. Statutory law, again, that's law that's been passed actually by the government. Before Enron was the major financial disaster I mentioned to you a few minutes ago. That was the major utility company in the United States, which went bankrupt, lost billions of dollars. The auditing firm, Arthur Andersen, actually went bankrupt itself, no longer exists. So that was unfortunate. They were one of the leading audit firms in North America and throughout the world, had a really great client list. And so it says before Enron, the major source of liability for accountants was the common law. Again, it would made sense because the government really wasn't involved in terms of passing legislation. The common law was such that if the auditors did something wrong, if they were negligent, then they could be sued under the common law for negligence. However, after Enron occurred, this major financial disaster in the United States, the government started getting more involved, as I mentioned a few minutes ago. Liability under the common law, as opposed to statutory law, says liabilities of public accountants, auditors, may arise from the law of contracts or as a tort for negligence. So when an auditor is hired by their client, they sign a contract, right, in order to conduct their audit in accordance with generally accepted auditing standards. But even beyond the contract, in common law, there's something called a tort. So a tort is when you hurt someone, okay? And one of the torts in law is called negligence. If you're negligent, right, you can actually be sued. Further in the PowerPoint, it says breach of contract is a claim that services were not performed in the manner agreed. So that's one way that clients can sue their auditors. Hey, auditor, you said you would do X, you did not do X. You breached the contract, we're going to sue you. However, the rule of tort can compensate victims beyond the client, right? And anyone who's been harmed by the work of the auditors where it's negligent can sue the auditors. So a contract is between the auditor and their client. But tort law, people other than the client can sue the auditors. Okay, so this is very commonly what happens in lawsuits. It's not just the client. Okay, it's people other than the client suing. So in the common law, if you want to sue someone and claim for damages, you have to prove your case. Right? The plaintiff has to prove their case. So what is it that a plaintiff has to prove if they're going to sue an auditor? So a number of points we see here. First of all, the plaintiff has to prove that they were damaged, right, or suffered a loss somehow. The second point, was there a beneficiary relationship with the defendant, okay, with the audit firm? A beneficiary relationship could be as a contract, right? Yes, there was a contract between the audit client and the audit firm. So that would be a beneficiary relationship. The third point, were the financial statements materially misleading, right? Or auditors was faulty for some reason, okay? Which means the financial statements themselves could be materially misleading, but even if the financial statements were not materially misleading, if the auditor gave some faulty advice, right, that the client relied on or other parties relied on, they could potentially be liable. Did the plaintiff rely on this statement or advice made by the auditor? Right? The auditor may make a statement that's wrong, but if no one relied on it, right, the plaintiff cannot sue the auditor. They must have relied on the statement or advice of the auditor, which turned out to be faulty. The next point, the statements or advice of the auditor, which were incorrect, were the direct cause of the loss, right? So did the plaintiff incur a loss because of what the auditor said or did? Right? There has to be a connection, right? We call this connectivity. So there has to be a connection between the loss and what the auditor did or did not do. And then in that last point, the auditor was negligent, grossly negligent, deceitful, or otherwise responsible for damages. Okay, so in the law, you may be negligent or grossly negligent or somehow dishonest. Right? That's not what you're supposed to be doing, right? As an auditor, you're supposed to be honest. So when we talk about negligence, um, the next point says auditors may bring a lawsuit for breach of contract. Well, we already mentioned that. That's one way that clients can sue their auditing firm. It says the relationship of direct involvement between parties to a contract is known as privity. Right? So where there's privity, that means a relationship, right, between one party and another. The plaintiff, if that's the audit client, only has to prove that the defendant in the audit firm was negligent. Okay, negligent, not grossly negligent, just negligent. Okay, so we go back for a minute. It's going to go back to another point here. The last point here in this PowerPoint, I'm just going to minimize this a bit more. In PowerPoint 45, you see it says negligent or grossly negligent. Okay, so these are two different things in the law. So we go to the next PowerPoint. If there's a relationship between the parties, such as a contract, privity exists, some type of closeness. And where that closeness exists, the plaintiff just has to show that the auditor was negligent, not that the auditor was grossly negligent. Okay, so the standard is lower where there's a contract between the parties. The next PowerPoint says third parties. So these are parties other than the audit client. Okay, so these are parties who are damaged, okay, but don't have a contract with the audit firm. So third parties can file a lawsuit under the tort law. We mentioned a few minutes ago, tort law is negligence. What does negligence mean? It's a failure to perform a duty with a particular standard of care. Remember, we said a few minutes ago, auditors are required to use due care. Right? If they don't use due care, then there can be a problem and they could be sued for negligence. So where third parties sue for negligence, what do they have to prove? Was there a duty of care owed by the plaintiff to them? Okay, so did the audit firm have to use due care in doing their work to protect the third party? The next point, there must have been a breach in the duty, meaning the auditor did something wrong. There must be proof that the plaintiff was somehow damaged. There must be a proximate connection, right? Here's a connectivity between what the auditor did wrong, the breach of duty, and the resulting damage. Okay. Do auditors lose all cases that are brought against them? No. The auditor just has to prove that one of these four requirements does not exist, right? If one of the four requirements does not exist, then the auditor will not be found guilty. So we said a minute ago, if someone, a third party, wants to bring a lawsuit for negligence, there must be a duty of care owed by the plaintiff to the third party. Keep in mind, third party is someone other than the audit client. Well, to whom do auditors owe a duty of care, right? Is that everybody in the world? Do auditors owe everybody in the world a legal duty of care? Well, they owe a duty of care, of course, to their client because they have a contract with their client, right? The contract requires them to complete an audit in accordance with generally accepted auditing principles and generally accepted auditing standards. Those standards require, right, that the auditor use due care. Other than the client, excuse me, other than the client, who else do they owe a duty of care to? The other parties are perhaps the shareholders, right? The shareholders of the company. So the shareholders, it says, cannot sue on behalf of the corporation. So if the shareholders lose money, they can't say, hey, auditors, you had a contract with the corporation, so because I lost money as a shareholder, I'm going to sue you. That doesn't work, right? There is no contract between the audit firm and the shareholder. The contract's between the corporation and the auditor. So the shareholder cannot sue based on contractual law. They can only take action as third parties, which means they have to rely on the tort of negligence. Due care, we already mentioned, it's a legal standard, right? And that's why I mentioned earlier, it's a legal standard because it's the standard that the court is going to look at to see, did the auditor do their work properly or not? So with respect to due care, what is it? It says due care is that care required of a reasonably prudent practitioner, auditor, okay, reasonably prudent auditor. So the court will look at a particular situation and say, what would a reasonably prudent auditor have done? We call this the prudent auditor test, right? What would someone with sufficient years of education, sufficient years of practice, what would that auditor have done in these particular circumstances? So the prudent auditor test, it's not the highest standard for an auditor. We're not saying auditors have to be perfect, but we're also not saying auditors can be negligent, right? The minimum standard. There's somewhere in between the maximum and the minimum standard. It's the prudent standard. Now, because of this issue around liability, right, our audit firm's going to just sit back and say that their audit clients can sue them, and will be more than happy to write a check. No, firms have tried to protect themselves, so they have created what today is called limited liability partnerships. Okay, so let's look at some of the terminology here. It says joint and several liability means any of several defendants that have caused part of the damages are liable to the plaintiffs for the amount of damages. Okay, so what used to happen, okay, was that, let's say, I'll use Deloitte since I was a partner there. Deloitte used to be a partnership of individuals. Okay, and so if I had a partner in Deloitte and that partner did something wrong in an audit, the firm itself could be sued, plus all the partners in the firm could be sued. Right? Just not the partner who did something wrong, but all the partners. So because all the partners could be sued, that's what's called joint liability. Because I was a partner in the firm, I also was liable for things my partner did wrong. Several liability meant as an individual, the partner that did something wrong was also liable. But there was joint liability, right, which meant I could be sued as well by a plaintiff. So this was not a very good situation, right? And so the firm itself could be sued, all the partners could be sued. So the partners in the firm wanted to protect themselves. So the way they did this in today's world, they formed limited liability partnerships. Okay, so a limited liability partnership now is that, let's say Deloitte is sued. In a limited liability partnership, Deloitte is now owned by a series of corporate partners, right? As opposed to me as an individual, I would have a corporation that owns my partnership interest in Deloitte. So now when Deloitte is sued, okay, Deloitte as a partnership, the firm is liable, okay, potentially if they're found guilty. And then the partner that did something wrong is also liable. Even though they have a corporation in place, the partner is personally liable. However, in this structure, a limited liability partnership, all the other partners are protected. Okay, all the other partners cannot be sued if one partner did something wrong. So this was actually an improvement, right, for auditors on an individual basis, because they're saying, well, I want to protect myself. I don't want to lose all my personal assets. So the government in North America allowed audit firms to form limited liability partnerships. Limited liability, LLP, right? So today you see Deloitte LLP, KPMG LLP. The LLP is meant to tell the public that it's a limited liability partnership, limited liability. So if you sue Deloitte, if Deloitte loses, all the assets of Deloitte, the firm, are at risk, plus all the personal assets of the partner or partners that did something wrong. They're also at risk. But for all the other partners, their personal assets are not at risk, right? So this was an improvement for auditors in trying to protect themselves. Again, the reason for this was that the Sarbanes-Oxley Act in the United States, and again, we introduced essentially the same legislation in Canada. This required auditors to meet higher standards. So, and management also had to meet higher standards. Well, auditors had to meet higher standards in basically two ways. One was they were required to do a lot more work in auditing of computer systems. Okay. Excuse me. We know that computers, of course, over the last 30 years in particular, have taken on increased importance in terms of how they process accounting transactions. Auditors were at one point not really doing sufficient work over computer systems. So this changed in 2003 when the Sarbanes-Oxley Act was brought into existence. And the law said, auditors, you have to do a lot more work, more complex work when you're doing auditing. In addition to that, the government said, not only do you have to do more work in terms of auditing of computer systems, you must audit management's internal control as it relates to reporting controls. Okay, these are controls in place to ensure that the financial statements are proper, right? And so this created more risk for auditors, right? Having to audit computer systems at a higher level, having to audit management's internal controls over financial reporting. And so since the government was requiring auditors to perform at an even higher level, there was greater risk that auditors might get sued. And hence the government said, okay, you can form these LLPs and that will help to protect you on a personal level. Okay. Now, when individual firms or auditors get sued, they want to defend themselves, right? So it says the defendant, accountant, in a common law action presents evidence to counter the plaintiff's claims. We saw a few minutes ago, right, a list of 4 or 5 points that the plaintiff must prove. The defendant, right, will render evidence that shows that they did what was proper. The next point says the primary defense or the main defense against a negligence claim is to bring forward evidence that the audit was conducted in accordance with generally accepted auditing standards and due professional care was used, right? So you want to bring forth evidence, say, hey, judge, we did what was required. And not only you as a firm say that, right, bring in one of the other firms and have one, have Deloitte say, yeah, KPMG did a good job. Their work was in accordance with generally accepted auditing standards, and they did use professional care. Okay, and so this is the type of situation that auditors will try and defend themselves. Okay, so everything that we've talked about up to this point, right, was really about the common law. Auditor's liability under statutory law, right? Again, statutory law is law passed by the government. So in the United States, of course, the SEC, which is the Securities and Exchange Commission, gives the SEC the legal right to decide what is generally accepted accounting principles, right? So in the United States, because of the problem over Enron, okay, the government took control of the auditing profession. In Canada, that's not the case. We as a profession prevented the Canadian government from taking over the audit profession by saying, dear government, we will implement the same controls, okay, that the US has forced upon their audit profession, as long as you don't get involved in monitoring and controlling us. So the Canadian government agreed, okay, that as long as the auditors implemented essentially the same controls, which meant they had to do more computer work, which meant they had to audit management's internal control system over financial reporting, right? Meet the higher standards and force that ourselves. The government said, okay, we're not going to get involved. But unfortunately, in the United States, through the Securities and Exchange Commission, that's not the case. they're controlling, right, how audits get done rather than the profession. Okay, so again, this PowerPoint 52, 53, where it's talking about the legal aspects of things. You're not responsible to know specifically what's going on in Canada and the United States. I just wanted to mention to you the main thing is that again, PowerPoint 54, 55, talking about specific legislation in the US. You're not responsible for that, okay? And even, okay, we'll get to the last PowerPoint here, number 57 in a minute. But the main point is simply this, that in the US, right, it's the US government that's running the audit profession these days. In most countries throughout the world, otherwise, it's the audit profession, right? So we want to try and keep control over our own profession as opposed to the government telling us what to do. Right? But again, because the U.S. economy, of course, is so large, the U.S. government decided, they didn't want to trust the audit firms anymore. So unfortunately for the audit firms in the U.S., they're very reliant on the government right now, right? In terms of the new standard setting. Legal liability implications for auditor practice, right? So what does this mean? What effect did the increased legal standards have on auditors? So the legal liability implications for the audit practice, be wary of the type of clients you accept, right? Don't take on clients that are going to create legal liabilities for you, right? Where management is questionable, right? In terms of what they do and how they conduct their business, right? So who wants high-risk clients? It's saying stay away from high-risk clients. That way you're less likely to get sued. The next point, very, very important, know your client's business, right? So knowing your client's business is a very good way to protect yourself, okay? Because when you look at the numbers, you'll know what makes sense and what doesn't make sense in terms of the data, and you can challenge it, right? So that's extremely important for an auditor to understand their client's business. Performing quality audits. We saw a few minutes ago, right? One of the main reasons that auditors got sued was that they did the work improperly. They didn't understand the audit standards properly, but 29% of the time it was because they actually did the wrong audit procedures. Well, you have to get on top of your game, right? You have to understand the standards better. You have to be able to implement the standards better in terms of your detailed procedures, which means you need more supervision of your staff, right, to make sure they're doing the work properly, right? Okay. Now, a big part of increased litigation for auditors, what they discovered was their documentation was very poor. So again, this is basically starting back in the 1990s, okay, but fast forwarding into the year 2000 to 2005, when a lot of these lawsuits came around because of the dot-com bubble that burst, auditors discovered our documentation is very poor. We need to increase the amount of documentation that we have in our files. Well, think about this for a minute. We have to do more computer work, right, on our clients. We have to audit our clients' internal control systems now over financial reporting, and we have to increase the amount of documentation in our file. All these things take more time, right? And professional time is expensive, which means what? Audit fees are going to go up. So over the last 15 years, so basically since the Sarbanes-Oxley Act was introduced in the United States, it was actually 2005 it was passed. So if you went from 2005 to 2020, in the United States, audit fees have gone up approximately 40%, 40%, right? So huge increase in audit fees. If you watch some business shows, CNBC and other business shows, you'll see top management from these public companies often complaining about Sarbanes-Oxley and the increased costs of auditing. Well, yes, auditing has become a lot more expensive, but on the other hand, in the last 15 years, right, it will be difficult for you to find a major financial disaster that was caused by a poor audit. You just don't hear about it anymore, right? It's going to happen. I'm sure there'll be another major fraud somewhere. But for the last 15 years, right, you haven't heard much about financial statement fraud. It's because auditors are doing more computer work. It's because auditors are doing more work over their clients' financial controls, over financial reporting, and boards themselves, as a result of Sarbanes-Oxley, have had increased governance, okay, put into effect. CEO now must certify the financial statements as being correct each year. CFO must certify the financial statements as being correct each year. So they have increased personal liability now, right? If the financial statements are wrong. So this increased level of liability, right, means that they have reacted and they want to do things properly. Same thing for boards of directors. They're required to have more control over management, right? If they don't, then they can be sued as well. So more and more liability, right, has been put in these different parties. So to protect themselves, they're all doing a better job. Boards are doing a better job. Top management, because they have to sign things, are doing a better job. Auditors, because the standards are now higher, they're doing a better job. But coming back to the documentation, right? When you go to court to protect yourself, the courts will ask to see audit evidence. Well, if you haven't documented, right, your procedures properly, if you haven't documented why you did certain things or didn't do other things, if none of that's documented, the court can't look at it, right? So it's sort of a case where the courts will look at it and say, not documented, not done. We don't know whether to believe you or not. You may say things in court to support your case, but because things weren't documented, can the court really, rely on what you're saying or not? So this will go to the integrity of the parties, of course. So in order to protect themselves better, firms do a lot more documentation now. So a few examples: forceful management letters. A management letter is a letter written by the audit firm to client management at the end of the audit, talking about the weaknesses in internal control and the improvements that should be made, right, in order to enhance the internal control system. So more forceful, right? In addition to that, it's not listed here, but there's something called a letter of representation. A letter of representation is a letter that management signs at the end of the audit that says the financial statements present fairly. And there's a lot of other representations put in the letter by management that they have to sign. That letter is given to the auditors. Okay, so the auditors are much more specific now about what goes into that letter, especially with respect to high risk areas, right? They want management's representation on high risk areas. So in case something goes wrong, management can't say, well, we never said it was the right number, right? No, the auditors have better letters, right, from management stating that the numbers are correct. Detailed memos in the working papers. So the working papers is the document that the auditors create. So usually today it's an electronic file. But in addition to the electronic file, there can be actually paper files, right, or paper documents scanned into the audit file. And the auditors make better memos noting, here's what I did and why, okay, or I didn't do this and why. So documenting their decisions better, right? And when the decisions are documented at the time that the work is done, right, that creates documentation that courts can look at a later time, right, if they need to see what was actually going on, right? Okay. The next point, documenting discussions to reduce audit fees or changing to a review engagement. So if a client is pressuring you, right, to decrease audit fees, right, or if a client is saying, well, let's switch from an audit to a review, right, which doesn't involve as much time in order to reduce costs, you want to document those discussions because that might be an indication that the client's trying to intimidate you, right, saying reduce the fees or we're going to do something else. Well, you want to note in your audit file how you reacted to that pressure. Okay, very important. So in total today, we've talked about how auditors, right, must remain independent, right, in appearance and in fact. And we talked about the different sources of liabilities for auditors, statutory law, such as passed, right, the Sarbanes-Oxley Act, and civil law, right, decisions by the courts, especially with respect to negligence, right, the tort of negligence, and that auditors are responsible not only to parties that they have a contract with, but also to third parties potentially where they are negligent. Okay. It wasn't in the PowerPoints, but it talked about the fact to whom do auditors owe a duty of care? Auditors owe a duty of care to any party that they can foresee. Okay, so if an auditor can foresee a certain party as relying on the financial statements, there's potential liability there. So, for example, if Deloitte is the auditor of company ABC Limited, Deloitte can foresee that the bank, right, that provides financing to ABC Limited is relying on their audit report, right? We can foresee them. On the other hand, a new investor in company ABC that's maybe considering an investment, right? Deloitte can't foresee that person. They don't even know who they are. They're not on the horizon yet. They haven't approached, right, the business to make an investment. So in that case, because Deloitte cannot foresee them, Deloitte has no responsibility to them. Right? It's only two persons that you can foresee. On the other hand, shareholders of a company, are they relying on the financial statements? Yes. So the auditor is responsible and can be sued by the shareholders, not under contract, right? Because there is no contract between the shareholders and the audit firm, but because the shareholders can be foreseen, right, by the auditors as to relying on the financial statements, auditors do have potential liability to them. Again, we talked about the number of steps, right, that auditors can take to reduce their liabilities. Form as an LPP, right? Be careful in the kind of clients you accept, right? Thoroughly know your client's business, do good quality work, right? Make sure you have good internal control letters on the weaknesses and tell management how to correct it, good documentation in your working papers, right? And of course, they didn't mention here as well, make sure auditors have insurance, of course, right? To make sure that if they do something wrong, at least there's an insurance policy behind them that a plaintiff can perhaps access money through an insurance policy that the firm is carrying. Okay. All right. Thanks, everybody. That wraps it up for today. Next day, we'll move ahead into Chapter 4. Again, if you have any questions or concerns, feel free to contact me, send me an email. If you want to set up a Teams meeting to discuss anything, that'd be fine. Just let me know. Okay. Thanks, everybody. Have a good day, and we'll see you on Wednesday. Bye-bye.